Hello and welcome to today's Delta Credit Tip. So you've applied for a mortgage through this COVID-19 crisis only to find out the guidelines have changed and you no longer qualify. What do you do, right? What are these new guidelines? How do we meet them? Well, stay tuned. We're going to fill you in on today's Delta Credit Tip. Hello and welcome back to today's Delta Credit Tip. I'm Michael Holmes from Delta Credit Restoration, bringing you yet more information to help you in your credit restoration process. Hopefully you'll find this information helpful. If so, give us that thumbs up. Don't forget to subscribe and hit the bell so that every week as we come out with new information to help you in your credit restoration process, you get this information as we produce it, you apply it right away, and you move forward with your credit repair process. So today we are talking about qualifying for a mortgage during the COVID-19 crisis. Because what's happened is the guidelines are changing literally every day. There are changes per lender, potentially changes with the government-backed loans as well. So now we've kind of got this moving target issue that we're working with. So unfortunately, by the time you probably watch this video, there's going to be more changes. So the key to all of this, as we have explained to all of our clients, the first step in credit repair is simply being cognizant of what's going on around you financially. And right now, as you're trying to enter into this new financial relationship with this mortgage broker or bank or whomever you're getting this mortgage or business loan with, you need to make sure that you're communicating, because there are a variety of things that have changed just literally every day regarding these loans, and you're going to want to stay on top of it. If you're in a mortgage and you have not yet gone under contract, in other words, you've been pre-approved, you're shopping for the house, or you're buying a new build perhaps, until you've officially contracted on that specific property and they've locked the rate and they've done all that, your loan is still kind of up in the air. You have not been 100% approved yet. You've been conditioned. Your approval is conditioned upon meeting a variety of criteria, and one of those criteria is that the property matches the mold of that loan. So you are still very much at risk as to not qualifying, even though you may be pre-qualified going in. Okay. Now the key is that with a lot of loans, you've got to understand the format of that loan to know whether or not the guidelines have changed. You've got your government-backed loans, which are your FHA, your VA, and your USDA loans. And then you've got your conventional loans that are strictly underwritten by the bank with no government intervention. Okay. So what we're going to talk about today is, what are those changes? Okay. So we thought it probably would be more appropriate for us to go talk to one of our preferred lenders. So what we're going to do is we're going to hop in the hoopty, go for a ride, and we're going to talk with one of our preferred lenders to learn about these changes. Hello and welcome back. I'm here with my friend Jim Gaffney of Amerifirst. He's been a mortgage lender for how long now?
22 years, give or take.
22 years. So
all good years.
Good years, of course. So obviously these last year has been a little bit different than the first 21, right?
Correct.
And so amid this whole COVID virus, we've had all these different changes. Everything's kind of turning on its head. So we're trying to figure out, well, I'm trying to buy this house. I'm trying to figure out what the new guidelines are. What can we expect now from a lending perspective on how these loans have changed as far as their guidelines?
Yeah, well, thanks, Mike. A lot's changed. To put it all into a short video is kind of difficult, but to give it a really empirical picture as far as what home buyers can expect, they can expect tightening of guidelines. They can expect a stricter criteria from banks as far as what it takes to get approved or to become eligible for financing. Just to give you an example, with FHA and VA loans, there's really a compression on file quality. So even though minimum standards really haven't changed per FHA and VA, a lot of lenders have taken their own considerations, their own overlays to just have better quality. So they're looking for better payment histories, more responsibly managed credit, better cash flows on bank statements. So it's just a great message for home buyers to really just tighten up a little bit on their spending activity and to kind of reel in what they're spending on a monthly basis as it relates to credit cards and credit usage. So those are really the biggest things that we're seeing right now impacting mortgage applications, which is just file quality. They're really looking for better quality buyers who have a lower likelihood of default.
So again, in being prepared for, we're first-time home buyers, we're second-time home buyers, whatever. We're halfway through our application, and now we're looking at some changes, right? So you mentioned that FHA really hasn't changed their guidelines, right? So the credit scores are still the same, the debt-to-income ratios could still be the same, but you said something about overlays. What is an overlay? What do you mean by overlay?
Yeah, good question. An overlay is the bank's ability to restrict certain categories in addition to what Fannie Mae requires. So Fannie Mae has a square box, right? Typically, square peg goes in the square hole. An overlay is where the lender changes that and says, hey, even though Fannie Mae allows for this, we're going to put the cutoff here. Okay, so for an example would be, let's say Fannie Mae has a 580 credit score for FHA, right? That lender or bank has all the ability in the world to say, well, we're going to start credit scores at 620 or 640 because we want a better quality. Not in a discriminatory way, just in a way where they're just having higher standards to somebody's credit history. You'll also see overlays in what we call debt-to-income ratios, where Fannie Mae and what we call desktop underwriter findings allow us to go up to, let's say, a 50% debt ratio, while certain lenders and banks may say, well, that's great that Fannie Mae allows 50, but we're gonna restrict it to 45% as a debt ratio because we want to protect ourselves from a potential default scenario. Right. So we don't want somebody going into a home already maxed out, even though Fannie Mae may allow it. So credit score limitations, loan to value limitations, these are all things that within that specific lender, they can tighten the reins on that and kind of restrict that buyer from getting approved, even though Fannie Mae may allow those criteria in that approval process. If that makes sense.
So, so what you're saying is that while FHA may not have changed, your specific lender may have. So now is probably a good time to maybe get them on the phone and say, hey, I'm mid-application, or hey, I'm about to apply, or I'm looking at a new build or whatever, and say, okay, what's changed and how do I react to that? 100%. Because the scores could change. Like I said, the debt, how much debt you're carrying at the time of applications changed.
Reserve requirements. We're starting to see a reserve requirement asks from lenders where they're saying, hey, we have you pre-approved, but now we want to see that you have 2 months post-closing reserves. I mean, they want to know that you can make 2 months worth of mortgage payments after you close. Right. That's called post-closing reserves. So they're asking to see a little bit more money from buyers, and that's okay. This is a great market. It's a great interest rate environment. Really just a phenomenal time to buy. If you're in a stable job, you consider stable in your employment, this is actually a super time to buy right now. But you're going to need to pay a little bit more attention to your credit and to your overall financial profile. And if you're already pre-approved, I would recommend you kind of revalidating that pre-approval. Some other things have changed, like PMI, which is super important. Principal mortgage insurance is something that you pay when you put down less than 20% on a home. Principal mortgage insurance rates have increased. They've increased. So if you were pre-approved a month ago and your debt ratios were very tight, your PMI increase now may exclude you from what was your pre-approval amount. So just get educated on it. Contact your lender. Take a look at your credit. Get with a credit professional. I know somebody who's really good at it right here. But get with the credit professional. Your credit score is so important. It's affecting your ability to qualify. It's affecting your interest rate. It's affecting your PMI payment. So having a credit score between, let's say, 660 and say 700, that could mean anywhere between $50 and $100 a month in payment as it relates to your rate, as it relates to your PMI. you're talking about, $7,000 to $9,000 over a 10-year period of additional costs just as a result of your credit score. So important to know your credit. Try to keep those balances as low as possible. Talk to a credit professional like this guy, and get set up for success.
Awesome. So key here is that there has been a lot of changes because obviously the banks are kind of hunkering down. Now, correct me if I'm wrong, at Amerifirst, you're acting as a broker, right? So you've got the ability, this lender may have changed, but this lender may not have. This one's changed a little bit more, so you have more flexibility. So if you're right now in the middle of, say, a loan with a specific bank, you could be in or out depending on the guidelines. But with a company like Amerifirst, you can possibly just shift to a different lender. Or how does that work?
Yeah, we're actually not a broker. We're a correspondent lender, so we're lending our own money. We're not a bank. A bank would be something like a Wells Fargo, a Chase, BB&T, SunTrust, Fifth Third, and so on. Those are banks where they're collecting assets, where they're actually getting assets from people who have checking accounts and savings accounts, investments. So they operate to different standards with their mortgage debt. We're a strict correspondent lender. We have the ability to broker out for a specific program. So if our own product, which is really strong, if we can't find it within our own product line, yes, we do have the ability to broker out and find that open channel for what's available for you. So examples of that are like, bank statement programs and specific investor programs, or brokering out loans where we don't offer the program for someone maybe who was in a foreclosure a year and a half ago or 2 years ago, but we still offer that through as a third-party originator, and we can broker that to a separate lender who would be able to fund that loan in that example. So, short foreclosure time frame, bankruptcies in the past couple of years, these are all things that would exclude that candidate from a Fannie Mae or Freddie Mac loan. But there are broker entities that we have relationships that we can send those loans out to for approval.
Fantastic. So key is talk to your lender, have that open dialogue, make sure you understand what those guidelines are. As we tell all of our clients, the first thing that we always look for in credit repair is that you understand what's going on around you financially. And that means having that clear, concise communication with your lender, like Jim here at Amerifirst. So hopefully this information helps. If so, again, give us that thumbs up, subscribe, and hit the bell. And tune in next Thursday as we bring you yet more information to help you in your credit restoration process. Thanks again, Jim.
Thanks for having me, Mike. Appreciate it.
See you guys next time.